promised last week we're going to be talking about some of what is generally referred to as alts. Alternates can mean anything in the investment world, my goodness, without getting into the details, but specifically private equity and private debt or private credit. To distinguish, private debt, private equity, private credit, private means it's not publicly traded, which is what the investment most people are familiar with, and specifically what we're talking about with publicly traded.
So it's available on public exchanges, and it can be freely purchased and sold by the general public.
Yeah, like just the New York Stock Exchange or NASDAQ or mutual funds. I mean, these are available to the public and because of that, very highly regulated by the Securities Exchange Commission and other regulators to make sure that the public is given a fair shake, right?
Yeah.
But private equity and private credit is not like that. It's wicked complicated. It used to be you had to be an accredited investor. It was called a Regulation D offering, and you had to have somebody that's pretty sophisticated and smart to assume, often that wasn't the case, but assume to know enough to be able to assess the risk and make a good investment decision. But it was a bit of a chore to be able to get it and to offer it to the public. But the companies that generate this sort of vehicle are huge. They have a lot of political influence. And now this stuff is available everywhere. Crackers, they're putting it in 401ks. So I think it is important, for us to kind of talk. And a lot of this stuff is blowing up. And this is prompted by a recent Wall Street Journal article. It says private credit investors are cashing out in droves. Redemptions by individual investors and funds soared at the end of 2025 after performance declined, reviving questions about suitability. So some of the concerns we have about, have you any of your clients pinged you on private credit, debt, equity, or alternates in general?
Not a huge amount. I mean, we've had these conversations with a few clients, but it's not something that's, at least from my experience, it hasn't been something that's just out there all that much.
You either?
Yeah, I think only maybe a few questions, but more like how to, if they wanted to be involved in like a private equity or a company that's not publicly traded, invest in that. But yeah, not something that's really on their radar because they're probably not noticing it in the 401ks,
But in some companies, some CEOs just refuse, and I'm among them, to allow this in there because it's so hard to understand and they're so risky. And there's a couple of really, really big red flags. And I tell you, when you speak to folks that are not clients, they're invested in private equity, they're happy as pigs in what. And the reason I think is because they look great on paper. But here's the thing about private equity and private debt, private investments, right? There's no public market for them, remember. If I'm selling a share XYZ, I know pretty precisely what it's worth because I can see it on exchange. This is what people are paying for it. This is what they're selling it for. There's a lot of, and there's a lot of people looking at it. So the pricing mechanism is very transparent. It's a very liquid market. Everybody knows what the value is based on a willing buyer and a willing seller, which is really the definition of a fair price, right? But private is different. Nobody knows what it's worth. So when a private equity investor gets a statement, you see, if I'm the manufacturer, I'm going to say, well, what do you think it's worth, Lou?
No, I don't know. Just come up with a number.
Come up with a number. Go ahead.
$50.
$50. What do you think it's worth, Anna?
Could be $55.
55. You know what? But we told the clients it was worth 55 last quarter. They won't be happy with the same number. Let's say it's worth 60. It'll look really good. What do you think?
Hey,
60?
60. I'll go with 60. Yeah.
Will you give me 62?
Yeah, let's do 60.
Okay, 60. And that's how it goes. It's not a real number. There may be some valuation mechanism or formula, in the structure, but often that is subject to considerable wiggle room. And take it as a qualified, the appraiser and valuation professional. There's a lot of ways you could turn those assumptions to get the number that you want. And that really is the problem. Nobody knows what it's worth. And I tell you, this is evident in a lot of these deals because this industry, private equity and private credit, has been suffering. And in fact, here's a quote: private fund managers, including Apollo Global, Blackstone, and Blue Owl, blame fear-mongering about a recent spate of corporate bankruptcies like Automotive Supply, First Brands, and so forth. But they're getting hurt. Nobody wants this stuff. They're having trouble turning the deals over. And one of the things they're doing now, I'm making these numbers up, but it's based on my reading, is that say that we have a fund that's time for it to be liquidated. So behind the person, behind the camera person, Zeta, you've got your time to liquidate that. You're getting out, and we give you $30, and we're setting up an alternate vehicle because there's nobody who wants to buy it on the market. They're having trouble, so they have a new offering that they sell to new investors, and they could take that same thing they gave you 30 for and sell it to them at 60. And begin generating new commissions and new fees and all kinds of stuff. It's a real shell game. And I strongly caution you, if you're considering these, if you have them, to maybe peel back the hood, or if you're looking at 401k, I would not get in my retirement money in this kind of stuff, particularly because the market is going south pretty bad and has for a while. And the other concerns are lockup periods and gating. Do you guys know what that is?
Yeah, I mean, it's restrictions for when an investor can take the funds out. There's lots of different restrictions that these funds can impose. So it's not like a ETF or an index fund or a stock that you can sell and have cash very quickly. They can restrict, how quickly you can get funds if you need it.
Yeah. Do you have any thoughts on that?
Yeah.
It's called gating typically.
Right. So basically, keeps you in there. You can, if you want to sell it, you have to either have a certain volume or a certain timing before you can get out. So it's not freely traded.
And typical mechanism is like, we will not liquidate more than 5% of the fund per quarter.
Correct.
That's the gate. And once you get there, and there's a lot of guys looking at gate crash. They said, this is not doing what I was told it was doing. I want to get out. But you can't. Maybe you can find somebody in the back of the pizza parlor and sell it to it cheap, because it's not a public market. But, in terms of the redemption mechanism with the fund that generated it, you could be out of luck. And it's becoming a real problem. And these investments span, I've seen, blue collar companies being rolled up into these, a bridge maker. Actually, I was evaluating it and didn't get enough information to be able to be comfortable with it. But it couldn't be, they can real estate, it's foreign investments, it's roll-ups of a bunch of other companies, it's private credit. What does that mean? That means that companies that can't get a loan from a bank or even get a public loan, they're like, risky companies. They got to raise like junk bond rates. So private credit is, I will take the loans from Lou's Car Wash because he can't get money anywhere else, and he's willing to pay 14% because he's that close to bankruptcy and he needs the money, and I'll roll it up into a vehicle like that with a bunch of other things, and I'll put a shiny cover and slick brochure around it and sell it, to somebody that is works for an electrician in a 401k.
Mm-hmm.
That's what's going on here. So beware. Any closing comments on this?
Yeah, and I have received a couple of, I have a couple clients that kind of are out there on social media, whether it's Instagram, Facebook, and there's a lot of these so-called advisors that are pushing private equity.
And why is that, Lou?
Well, there's high commissions on this stuff. There's high, the fees are high, the commissions are high for them. So it's in their best interest from, HIP National perspective to get this sold. But they're out there, and I just want to caution you again to know who you're listening to. Make sure that this is a credible source. Make sure these are credible people that know what they're talking about before you take pieces of your portfolio and invest into something like this. Otherwise, you can end up getting burned.
Yeah, well said. I mean, exactly. That's the reason that these are manufactured and being pushed so hard, and the shenanigans is because it's a very profitable product to manufacture, and increasingly, the buyers are drying up, and they're having to play a lot of games to keep their own cash registers ringing. I mean, this is something we have evaluated for years, and for the reasons that we've discussed, we've always shied away from it. And it's particularly disappointing in the market because it's sliding downhill. Do you have any closing thoughts? Last word to Andrew Wunderlich.
Yeah, I'll piggyback on Lou as well. Some of these.
It's a long climb to get up there.
Some of these people, these two-hat advisors that aren't fee only.
And what's a two-hat advisor again?
Someone who's a broker and also
So say I'm a fiduciary,
Yeah.
and then you can pay me a small fee, but then my advice is going to be to buy these products,
Yep.
and you think I'm still a fiduciary, but I'm acting as a commission broker, and you're really getting soaked.
Exactly. And like he said, it might be something they're like, oh, we can add these alts to your portfolio. They're these diversify, but you got to realize they're, like he said, they're making money from those commissions and fees.
And so long as you're looking at the statements, again, happy as a pig, and you know what, but it's not. It's a make-believe number. It's dangerous. Especially if you expect to retire in a reasonable time frame. When you actually go and look at what you got, could be a pile of poopy. Hope not. Anyway, thank you so much for watching our Super CFPs, Lou and Anna, and me, your wealth doctor, Jeff Kamar. Until next time, make sure that you keep your eye on Smarter Money Matters, because it matters.